Hi, I'm Linda Eedes. This is an update on the RECM Balanced Fund, which is, of course, our Regulation 28 Balanced Fund. I'm going to talk to the third quarter of this year, which is 2018, look at the returns the fund generated during that time period, also look year to date, and then sort of talk a little bit about how the fund is positioned currently given sort of the local and global backdrop. So if we look at the fund's returns, it was down 0.5% for the quarter, which isn't too bad given the fact that the South African equity market was down 2.2%. But better news is that year to date, this fund is actually up almost 2%. So it's up 1.8% to be accurate, net of fees. And that is actually in sharp contrast to, first of all, the South African equity market, which is down 10%, but also to most other Regulation 28 Balanced Fund, which tend to be a little bit more market oriented. So they tend to be positioned closer to the market index, whereas obviously as value managers, we tend to start with a blank piece of paper, which is why, of course, we haven't held stocks like NASPAS, which are big components of the index, for quite some time. That wasn't to our investors' benefit for a long time when NASPAS was doing very well. But more latterly, sort of NASPAS has been under quite a bit of pressure as a result of Tencent coming down quite significantly. And sort of as we stand today, it's down 22%. So not holding NASPAS has actually been a significant benefit to investors. If you look at the average of the sector category, so if you look at all the funds in that category and you sort of take the average of how they've returned over the year to date, it's actually down 2.2%. So that's kind of a good representation of what the sort of average fund out there has done. And so the RECM Balanced Fund has continued its trend of doing very well since the market has kind of turned in favor of value investors. That really started happening at the beginning of 2016, and this fund now is up more than 30% since then, whereas that average that I spoke about of the sector category is actually only up 6% over that time period. So a value-oriented portfolio has really been where your source of returns has come from in your diversified portfolio of funds, which hopefully includes some growth-oriented and momentum-oriented funds, as well as some value-oriented funds as well. So that's really the place that we sort of fulfill in the portfolio. It's really to provide the returns when the rest of the market may be coming under quite a bit of pressure. So if we look at sort of what generated the returns during the quarter, or where sort of things contributed or detracted, obviously a strong contributor to returns was the fact that this fund does make full use of its offshore allocation. It does have just over 30% in global assets, which is roughly split 1/3 cash and 2/3 global equities. Now, interestingly, we don't just as a matter of course use the maximum allocation. In fact, in sort of after Nhlanhla was fired, you might recall that the rand blew out quite significantly. We actually had quite a lot less offshore exposure than we do today, and a lot less than most other Regulation 28 Balanced Funds, because the rand was so inordinately cheap. Although the rand has weakened somewhat over the year to date, it's by no means where it was at that point, especially if you consider that the fair value of the currency has also deteriorated given the fact that we have higher inflation than most other economies, certainly the developed economies such as the US. So that was a source of returns during the quarter and the year to date. The global equity portfolio has actually been fairly resilient. Williams-Sonoma contributed to returns, which is the luxury homeware retailer. Their recent numbers suggested that they're not going to be entirely decimated by Amazon. Their online retail has actually gone up during that time period. We were also invested in Inpex, which is the Japanese natural gas and oil producer. One of their big projects, Eedes, off the western coast of Australia, finally started to ship natural gas to Japan, which has been 2 years of delays. So the share price sort of finally celebrated that. And we also have exposure to other parts of the market which did well, such as Berkshire Hathaway. Obviously, there's a big insurance component to that business, which tends to do well with rising interest rates, which we saw in the US. Some of the local stocks which contributed to returns during the quarter were FirstRand, which is actually up in contrast to how you might expect banks to perform, with sort of quite a poor backdrop in terms of the economic climate. But their recent set of results showed that they were proving to be a bit more resilient, I think, than the market was expecting them to be. And then packaging business Bowler Metcalfe finalized its sale of its beverages business, Softbev, and they announced that they would pay a special dividend, which the market liked, with part of the sales proceeds. And then on the negative side, some of the businesses which came under a bit more pressure were, for instance, MTN, which of course came under pressure as a result of the Nigerian authorities saying that they repatriated money out of Nigeria illegally and that they owe $2 billion in back taxes. MTN obviously contests this, but I think the important point with MTN is that the share price has come under a lot of pressure, but despite being one of our top holdings, it hasn't unduly affected the overall portfolio returns. And I think this is very important because I think one of the lessons we learned from our experience in 2014, 2015 was to make sure that your portfolio is sufficiently diversified to weather any particular stock or investment idea not playing out as you expected or coming under pressure in the short term. So I think it gives us some comfort, and hopefully gives you as investors comfort, that the overall portfolio has been very robust despite the fact that it held MTN, which has been under a lot of pressure. It has managed to obviously not hold a lot of stocks which have been sort of very much in the headlines. Stocks such as, for instance, Aspen, which is down 40% year to date. Tiger Brands is down 46% year to date. Woolies is down almost 30% year to date. A lot of these companies were the flavor of the day at some point. Most of them are still trading on valuations which would not represent value to us. But we're keeping a keen eye on many of these businesses. Fundamentally, they're still very good businesses, but the price needs to be on the right side of the fair value for us to be taking a look and investing. But you probably will see some more of those kind of businesses coming back into the local equity portion of the portfolio. Overall, the portfolio is a combination of high quality businesses on the global side, exclusively high quality on the global side, and predominantly high quality on the local side, with some exposure to the lower quality but inordinately cheap opportunities on the South African front. I think one of the advantages of being a smaller manager is that we have a much wider opportunity set to find value, particularly within the South African context. And I think that overall the portfolio is very robust, and I think is proving its mettle as a value portfolio within the context of the local market backdrop.